Welcome to This Week in Money. I'm Phil Mackesy. Today, Mike Swanson on gold's meltdown. David Morgan with what really happened. And David Skarica looks at what's next. We begin with Mike Swanson right after this.
The best of the best. Randy Elvis Frisky and his Las Vegas show band. 40th Anniversary Aloha Tour. This April in Camrose, Edmonton, Red Deer, Drayton Valley, and Lloydminster. On sale now. Details at randyelvisfrisky.com. Welcome to This Week in Money, the source for market opinions. Here is Phil Mackesy.
Mike Swanson is founder and chief editor of Wall Street Window. He's online at wallstreetwindow.com. Hey, Mike, it's good to have you back on This Week in Money.
Oh, thanks for having me. Good to talk to you.
We talked about a month ago, and gold at that time was around 1,600. Monday, the worst trading day in history for gold, losing almost 10%. Today, back over 1,400, and yesterday in the wallstreetwindow.com site, you had a pep talk for gold bugs. What did you say to our fellow gold bugs here?
Well, yeah, this has been a pretty incredible move the past week in gold. I mean, it's a total crash, basically, and it shakes people up. And I've been getting lots of emails from people wondering why it crashed. Some people have been selling out because they've owned too much or they don't believe in gold anymore. And others are convinced it's going to fall even more because of this drop. So I was trying to, answer people why, what made these things fall so much and to try to encourage people to hold, because I believe after a drop like this, the market will eventually go back up after a couple of weeks of stabilizing.
So what happens now?
Well, I think the best thing to do, and which is what I was telling people in this article, is look at past markets after they've had big collapses like this. And if you look at the 1987 stock market crash, or Europe last year is a more recent example. And I think there's a lot of similarities between gold and Europe because, or what happened in Europe last year, I should say, because what's happened is, people in the news and in comments, I've seen people say, well, gold's crashed, so a bear market is starting now. Mm-hmm. In reality, though, gold has been dropping since the end of 2011. So it's been in a 2-year-long decline. Essentially, I think a cyclical bear market in a larger bull market that started in 2002. I see this as a pullback in that's been going on since 2011. But in a bear market, the cyclical bear market, a short-term one, they last 1 to 3 years generally. Often they'll end in a capitulation, a final panic drop, and we saw that, for example, in the United States in 2009 in March, and in last year in Europe. That's essentially what happened there. The European markets had something of a crash last year too. In May, some of the markets over there were down 10% for 2 days in a row, and that's basically what's happened with gold here. It fell essentially 10% on Friday last week, and on Monday too. Gold and the gold stocks both around that amount each day. And that's not something that happens at the start of a bull market, but more towards the end. And we've already been in this decline since 2011. So I think this is the end of it. And further evidence of that is two things. One, the amount of volume, trading volume in these stocks, in the gold stocks, has been enormous. Like 5 times the volume in some of them.
Wow.
On Friday and Monday. And interestingly, too, on Wednesday, the stocks were down a little bit by the close, but in the last 60 minutes of trading, they did more. They were falling in the last 60 minutes on Wednesday. And in that last hour of trading, they did something very significant. They had the most amount of volume traded in a single hour from 3 o'clock to 4 o'clock than any other hour ever in them, including all the other hours that led up to that on Friday and Monday. So there was enormous selling volume on Wednesday on the close, even though you may not have noticed that if you just looked at the percentage.
Yeah.
The stocks were down that day, but that's what happened, and that's a sign too of extreme capitulation and so forth. And then finally, another thing too is that these mining stocks now, I mean, they've been cheap, you could say, for quite some time, but now, I mean, they're at ridiculously low valuations. Some of the stocks, I don't know if you want me to name specific ones.
Sure, go ahead.
But there's a few that have P's of 3 and 4.
Wow.
Newmont has a dividend of 5.5%. The GDXJ gold stock ETF has a dividend over 6% now. And so some people are saying, well, it must be over for gold and this and that. But when things get to have such cheap valuations, at some point when they bottom, they just are going to go up. And I think this is like 1987 or 2010 for the stock market. We had that flash crash thing in the sense that, you normally what you get after such a crash like this is a move, a sideways action, as some people will doubt and be scared and sell out while others accumulate. And the market stabilizes and recovers, builds a base. And it usually takes about 8 weeks. And then after that, it breaks out of its sideways base and starts a new bull market. And I think it can go up from there for 2 or 3 years, maybe more. There's no telling.
Mike Swanson from WallStreetWindow.com, our guest here on This Week in Money. Great quote here, Mike, today from Rick Rule, who says, I have every confidence that 3 or 4 years from now, we'll look back and say, God, the spring of 2013 was the good old days. The only thing that's changed is that people's attitudes have gone from aggression to fear, and the market expressed by junior gold mining shares is 70% cheaper. You agree with that?
Oh, yes, certainly. And I think he's right. One lesson about this I've taken myself is, I bought stocks last year in Europe after they crashed, and I bought other stocks this year too at different times. And one of the things I've noticed is for myself is these stocks and positions I bought after the crash in Europe last year. These are European stocks in Greece and Spain, other countries. I'm up a lot in them because I bought on a major low. And whenever they have a little bit of a pullback for a week or a few days, I don't even care. It doesn't bother me. However, stuff that I may have bought closer to the top of these markets the past couple months, if they pull back, I have a small loss on them. And so the point is that that's proof that the best time to be buying things is after a crash like this, and not when stuff is, much higher, which it will probably be 6 months from now or from a year from now. So I think Rick Rule's right. This is a great buying opportunity, just like Europe was a great buying opportunity last May. The U.S. stock market was in March 2009, and also after the 1987 stock market crash. And I keep drawing that as an example because that crash happened in the middle of a secular bull market, and I think the same is the case here. And the stock market went up, for 6 years after 1987, and had a little dip, and of course, went crazy till 2000. So I really think this is, a great buying opportunity, and you can get stocks that truly are at cheap levels, not just because the price is cheap, but because they're paying dividends. I mean, you can get a 5.5% dividend on Newmont Mining. It's pretty much unheard of.
Mike Swanson from Wall Street Window, our guest here on This Week in Money. And we've seen the news media full of stories about who is losing from the slump in gold. Some of the people who are making money, apparently, central banks. And the reason they want a lid on precious metals prices, the thinking goes, is they want the best price on gold, and they're also trying to build confidence in paper money. You think they're taking advantage of this situation?
I don't know. There's been talk or speculation that they had something to do with gold dropping, but I don't really see any evidence for that. I don't know if that's it's not really something that can be proven. One thing, though, make 2 points. One, though, is that they haven't really benefited that much from it in terms of currency appreciation. And in fact, the U.S. dollar is down too over the past week, so it hasn't benefited from this. And I think that suggests that the crash in gold, if they try to cause it or whoever, has not actually caused people to increase their confidence in the Federal Reserve or any of these other central banks. In fact, if you look at the value of currencies, the confidence level in these institutions has dropped, even if gold's falling. So if they were trying to make people feel more confident by crashing gold, they have produced a miserable failure.
Mike, what about the big bullion banks? A lot of folks feel that they are somewhat to blame here. And when you look at the forecast, starting in February, Credit Suisse predicts the gold market has peaked. Beginning of April, SocGen says gold will end the year at $13.75 an ounce. And just last week, Goldman Sachs says $14.50 an ounce by year end. And now here's the Deutsche Bank saying gold will fall this year amid a structural change in the markets. Are these guys front running the decline in gold, you think?
It's possible. I don't take their predictions very seriously, though, in the long run, because I don't know the exact record of all these banks, but I do. Goldman Sachs last year, and let me think exactly the time it was, but after the crash in Europe occurred and the bottom came, they were still predicting further declines. They were predicting the U.S. stock market would decline too, and none of it happened. And I don't know. I don't think these, their statements, I think, aren't really good for forecasting the future. They might be good for creating short-term moves in the market that they somehow take advantage of themselves, but they're no benefit to us, I think, in trying to follow their recommendations.
Mike, looking into the future, we're about 2 hours ahead of the release of the Commitment of Traders report from the CFTC. What do you think that's going to show us today?
It's going to be real interesting. I would think it's going to show that a lot more of this large speculators have been taken out of the market. We've seen some of the biggest trading days in GLD and liquidation in the gold market ever, so that should start to be reflected in that report. Although we might not see the full impact of these moves until next week's report because a lot of the data gets delayed for a week. We should see Friday's move last week in there, but probably not this week's until next week's report.
Mike, when we look back over the long term at what's been going on with the gold indexes, numbers pretty depressing. Look at this. For 5 years ending this week, the Huey down 38%, the XAU down 45%.
Yeah, well, the thing about that, though, is we've actually had three similar pullbacks since 2001. The first one, I think, was in 2003. It declined a similar percentage off of a high made in the summer of 2002. And, of course, there's also another one, I think it was 2005 or so. And, of course, there's the crash in 2008. Each one of these declines was a similar percentage as this past one from 2011 till today that you mentioned. And the thing is, gold stocks are extremely volatile, and that's reflected in those numbers. But when they go up, they also go up at an even greater percentage rate. So once this thing turns around, I don't think people will have anything to be depressed about. And I would think this is, next couple of weeks is the time to be buying and getting in.
Next couple of weeks, probably a good time to seek out some professional advice. And how can we do that through Wall Street Window, Mike?
Well, if you want to hear from me, you can just go to my website, wallstreetwindow.com, and I've got basically two levels of service. One is completely free, and I have multiple blog posts a week on there, and even put my real portfolio and when I buy and sell stuff, and that's all free. And then there's also a private group that does gets special PDF reports every week, and in a monthly live discussion session and stuff like that.
Next couple of weeks going to be interesting. Mike Swanson, the founder and chief editor of Wall Street Window. You can find Mike online at wallstreetwindow.com. Hey, Mike, thanks for this.
Yeah, have a good one.
This Week in Money is archived online at talkdigitalnetwork.com.
David Morgan is our guest. You can find him at silver-investor.com. It's home of the Morgan Report. Dave is coming to us today from Spokane, Washington, the heart of Morgan country. David, it's always great to have you on This Week in Money.
Well, thanks so much, Phil.
We talked about a month ago. Gold then was around $1,600. Now we are just climbing back over $1,400, a loss of nearly $100 this week. Even worse for silver. It's down more than $3 this week. I guess you've been having a lot of calls, people asking, what the heck is going on?
Oh, absolutely. I put out a few videos, as I do for my members, on the secondary service. It's a basic and a basic plus advanced, where I do charting, that type of thing. And I said, look, and I've been saying it all along, if we break the $26 level in silver or the $15.50 level in gold, look out below, especially silver, because it was basically a toothpick holding it up from about the $20 level. And that's how I referred to it. And, of course, it did happen, a lot of technical selling, but I think it was basically some collusion going on. I mean, you don't get those kind of amounts of metal being sold on a naked short position. In other words, this is paper selling, which, as I've said, so many times, I'm almost tired of saying it, but for a very long time, the market doesn't care if the selling pressure comes from fictional metal or real metal.
Okay.
And we got clobbered, and it's going to take some time to get it repaired.
You were talking about collusion a second ago, and it's something Mike Swanson and I discussed earlier today on This Week in Money. The big bullion banks, these guys, according to some folks, have been shorting precious metals as long ago as January and February, March, and April. They've all been talking a steady downbeat on gold. Is there some collusion here among the big bullion banks?
Well, I'm going to refer to a couple guys that I really admire that use the word. I mean, Frank Veneroso, who's pretty much distanced himself from the conspiratorial types and the gold bugs, has used the word in his one of his latest writings. And then you look at someone I think is real solid, which is, Chris Martenson, who did... visited Richard Russell, who's probably the stalwart in the industry. And Chris is, talking to Richard Russell about, collusion. And you can't really rule it out. Of course, these things are very difficult to prove, but, you just do have to look at a little common sense and use a little bit of your gray matter to figure it out, but it's not too tough. Basically, when you have the amount being sold, it's for one purpose, and that's to drive the price down. So if you go back and look at what the idea of the futures market was, it was a hedging vehicle. If you were a farmer and you grew wheat and it cost you this much and the price was higher, you could hedge your profit and know that you're going to make a profit for your growing season. And that was a basic idea. Of course, they allowed speculators in there because you need liquidity, and you're allowed to profit. And I have nothing wrong with, I don't see anything wrong with the basic idea. The problem has become, in my view, this is my opinion, it's a very strong one, is that the speculative situation has become obscene, and so you can make money, and a lot of it, by forcing a market one direction or another, even without the underlying commodity. So the idea that the CFTC is sort of considered is like, what's a legitimate hedge and what's, moving this market around for sheer profit. But they don't say it in plain English like that, and they're just still fiddle-farting around about it. And this is why these, bullion banks could go in and sell obscene amounts. There's only one reason to. I think this could be proven in court very easy. There's only one reason to sell massive amounts of a commodity that doesn't exist. That's only one, and that's the profit from it. And so, yeah, it's another takedown. But I want to be clear. I want to be consistent. You cannot alter the main trend, and the main trend is up. When I did this video I referred to at the beginning of the show, the main uptrend for silver and gold are still intact. But a lot of technical damage has been done, and a great deal more, I think, psychological damage has been done here. But the fact remains that the bankers are basically in collusion some of the time, and their overall thesis is paper good, anything else bad. Stay in the paper system, or else you're going to have problems.
David Morgan, our guest here on This Week in Money. And boy, you couldn't find a better explanation of what's going on than from our friend and your neighbor, John Rubino. He says, metals exchanges running out of physical product, facing default, governments sell tens of billions of dollars in gold and silver futures contracts, forcing prices down, triggering stop-loss orders and margin calls. Is that pretty much the way it went down?
Very succinct. John's a great guy. He lives actually fairly close to me, relatively. He's in the next state. Yeah, no, very succinct, better than I said it. Exactly. That's it. And again, I'll just back him up. I mean, the bag market in silver is non-existent. I mean, that's all in strong hands now. You have to pay huge premiums to get constitutional silver, pre-1964 or pre-90% silver. The bar market has a pretty good premium on it. The mints, you're going to wait 3 or 4 weeks. Some sites that are pretty good sites, meaning internet sites that sell a great deal of precious metals, are out. Or others that claim they have it that really haven't obtained it from the wholesalers. They're just basically a drop shipper. They're claiming, 6 weeks out, 8 weeks out. So just like in 2008, there is a shortage. You can't get it quickly of retail product. The problem, if you want to call it that, or the concern is always, what's the real silver story? And I emphasize the word silver because what we need to know is what is the commercial bar inventory like? And that's where we see some websites talking about, COMEX and default is going to default next week or next month, and basically they're saying a silver shortage. Well, no, I'm sorry. I would love to say that. Believe me, no one wants, I'd love to see it. I'd love to say it. I'd love to verify it. But for my ability to verify what's going on in Europe and what's going on in the commercial bar market, which all these retail products are derived from. I mean, the mint gets their silver because a 1,000-ounce bar gets melted down, extruded, stamped, sent to their press, and it presses it out to a silver eagle. That's the process. Yeah. And there is silver out there. In fact, there's a fair amount of silver out there in commercial bar form. So just like in 2008, you could make an argument for a shortage in retail product, but you can't yet make a forecast that we have a shortage in the commercial bar, even though you're seeing a great deal of internet chatter stating that there is. There is not at this point. You're taking it from me, follow me or not, believe me or not. In fact, I've got a call in first thing Monday morning with some of the largest refiners in Europe to see what they've got on hand. Now, gold, I don't really know, Phil. I haven't looked at it as hard. That will be part of my call on Monday. I just read something just before this interview on gold. Gold is more mainstream. I mean, let's face it, the bankers have been buying gold, and it's been hypothecated at least as much as silver, if not more so. And the fact that Germany asked for their gold and they can't get it for 7 years, give me a break. Yeah. And then the price goes down like this. So certainly something is going on. What the physical gold situation is, I don't want to comment because I don't have as clear a definition as I do on the silver side right now. And having said all that, let me just end with this, and I know I'm yakking a lot, but it's important. The amount of commercial bar silver that does exist as of this interview, that could be gone in a very short period of time. I mean, if the Eric Sprotts, the Stefan Spicers, the Zurich Continental Bank, and a few other the bigger players in the silver market decide, you know what, I like this price. I'm buying at 25 or lower. Send me 20 million ounces, 40 million ounces, 30 million ounces, and those 3-4 orders come in at one time. Guess what? What I just said a few minutes ago is incorrect. There's a very big problem in the commercial bar market, and that's how small the silver market is. So, I hope I'm painting an accurate picture. I really try to be objective. Yes, I'm biased. Yes, I want honest money. Yes, I want a fair financial system. Yes, I want these banking types to have to eat their own medicine and suffer the consequences of their actions rather than get bailed out by the populace of the planet. But, that's not the system we're in right now.
One of the things that confuses me, and I get confused pretty easily, is the effect of gold and silver prices on the economy. Here's two conflicting statements here. See if you can figure out which makes more sense to you. The plunge in the gold price may have raised a big red flag over the global economy. And on the other side of the coin, gold's drop hints at some underlying confidence in the dollar and the U.S. economy. So which is it?
Well, I'll do the latter first.
Okay,
yeah, there's a inverse correlation between the dollar and gold. So if you can get the psychology, which I think this move is mostly about psychology. It's about all those people that were out there thinking, maybe they should add gold to their portfolio, and then they see this big smash and they go, oh my goodness, it's way too volatile. No, gold's not the place to be. Stock market's the place to be. Dollar's the place to be. So that's a psychops type of move. And repeat the first one, Phil. I want to hear it again. Sorry.
And that was the gold price in the past week may have raised a big red flag over the global economy. In other words, the drop in the gold price is bad for the global economy.
Yeah. I think that the awake and aware, I'll call them, and this is opinion, are saying, look, this doesn't make any sense at all. And what you're seeing, as you just said, from John Rubino and many, many others, the physical demand from the little to medium-sized guys and gals, of course, are very, very strong. I just got something from Hong Kong. I think it was Rick Rule that reported it about, the line, how long these lines are going out to buy physical gold. So that drop is like a gift to people that are awake.
Sure.
The most awake on an international scale will be the Chinese, the Russians, and India. Not to mention, of course, subsets like, Hong Kong that's now, free, not actually part of China per se. Anyway, the idea is very clear. The Asian or the East is buying gold. Thank you very much. They're not stopping. They're not quitting. And then again, you got to go back to fundamental facts. Again, I'll repeat myself. If there's so much gold around and the price is so low, then why can't the Federal Reserve just ship off this gold to Germany that they own? Why can't they give Texas, the state of Texas, their gold? Why are all these delays? Well, it's obvious. They don't have it. It's been hypothecated, leased out, swapped, or whatever. And so they're playing their games on the price to try to force people to cough up more physical, and the opposite's happening.
Yeah. Now, did they see that coming?
Oh, yeah, I think so. I mean, if you look at Goldman Sachs, just before the big smashing, they came out with this public domain article saying you ought to short gold.
Yeah.
About 3 or 4 days later, dink, you dink, dink. And the other thing that, I get some emails occasionally, technical analysis doesn't work, and these chartists guys, I've been studying these markets for 4 decades, and technical analysis does work. And I forecast it to my members, the guys that pay me. I said, look, here's the deal. And like I said, I told them several times that if this area breaks, look out below. And so all these guys that trade futures don't give a rat's about the fundamentals. They don't care about the dollar. All they care about is how much money they make every day trading.
Sure.
And when they see a chart set up like we saw, they're going to jump on whatever side's moving. And if it's moving down, they're going to jump on that side of the market. And, of course, they did. They went along for the ride with the banks. So it's, again, going to take some time to repair. But remember, fundamentally, nothing changes. There's never been a fiat currency in the history of mankind that's ever survived. So, yeah, the dollar looks okay now. But 3 or 4 years from now, if you hadn't bought gold or silver on this dip, you may be looking back saying, gee whiz, I wish I had.
David Morgan with us on This Week in Money. Boy, if you thought things were tough in the bullion space, how about this for the gold miners? Headline, 15% of world's gold miners face collapse after plunge strips $169 billion off the market value. And boy, some grim numbers. Goldcorp down 30%. Barrick hitting an all-time low of $20 a share, off 54%. Newmont off 23%.
Yeah, that's true temporarily. I mean, I don't see the producers that are, making money on gold at these levels, meaning the 1,400 level where we're talking, going out of business.
Yeah.
Now, a lot of these smaller companies that are not producers, their history, they are not coming back. And so you got to be very careful. I was just talking to actually a CFP, they call him down here, a certified financial planner, and he was asking me for advice for some of his clients that have some metals exposure. And we were talking about, the portfolio that we have recommended, and he talked about another newsletter writer that's, 25,000 times more famous than I am. I'm exaggerating, Phil. 20 times more famous than me. And then this guy was reading him forever and just losing. And I'm not saying I'm making a lot of money for my people now. I don't want to misconstrue this. But anyway, he switched to our report and says, geez, that's the portfolio I've been looking for. That's what I want. So that was kind of nice, especially to hear it from a professional like that. But anyway, back on point, I wouldn't stress too much unless you are just loaded down with juniors. And the problem with the newsletter industry is almost all these people write about these little itty-bitty micro-cap stocks that are going to make you billions of dollars because it's only 10 cents now, and it's sure to go to 100 and all this nonsense. And I just stay away from that for the most part. We speculate a little bit, and, my speculations, and someone you and I both know very, very well, calls my speculative group blue chips because most of them are producers or near producers. I mean, I don't mess around. Our staff, it's not just me, our analysts, we look at stuff very seriously. We don't want anyone to lose money. Are we down? Yes, we are. But most everything that's on our list are going to come through this, and 2, 3, 4 years from now, I think strongly that we're going to be in a very profitable position.
You can find David Morgan at silver-investor.com. It's home of the Morgan Report. And you can follow Dave's Twitter feed at silverguru22. David, always good to talk to you, and have a great week. Thank you, sir.
Thank you so much, Bill.
This Week in Money is archived online at talkdigitalnetwork.com.
David Skarica is author of The Great Supercycle, Profit from the Coming Inflation Tidal Wave and Dollar Devaluation. And you can visit Dave at addictedtoprofits.net. It's always good to talk gold with Dave Skarica. Dave, good to have you back on This Week in Money.
It's great to be here again.
You were not kidding when you said gold gets whacked. The worst trading day in history for gold Monday, losing almost 10%. Gold back now above 1,400. We're still looking at a loss of about 7% this week and a loss of about 10% for silver this week.
Yeah, that was, well, the rumor is there was some huge option sell that came in that was the equivalent of like one trade that was equivalent at 15% of gold production for a year. And that was just too much for gold to take. And that's what drove it under 1530, 1520, which was the key support level. And then when that happened, you triggered all kinds of stops and stop losses and margin calls, because that was the big kind of consolidation, the bottom of the consolidation since 2011. And then you just kind of had this watershed decline. And on top of that, then you had the stocks really, really tank and gap down 3 or 4 days in a row as well. For example, American Barrick, which I've been buying a lot of this week just as a disclosure, started trading quadruple, quintuple, sextuple, its daily average volume.
Wow.
On that, which is just a sign of liquidation and panic and all that sort of thing. I think what you got is a lot of funds that are just long, say, gold and commodities, thinking based on the QE trade, which has been going on since the financial crisis, and they all got stopped out. And just so you know, in the longer term, I think this is really positive because it's kind of shaking out the weak hands. It's shaking out maybe people that were in long the market, but maybe not quite long for the right reasons. And then once you shake them out, you don't have that overhang left, to sell into that.
It looks a little violent when we just look at it from our perspective, but this is the way markets work, right, Dave?
Well, it's actually a lot like 2008 and even the 70s. And one thing I'm noting right now is that if you look at the 70s, there were two 60% plus declines in gold stocks, or 60s to 70s. Basically, gold stocks went up from 1960 to 1981. The Barron's Gold Index, which is about the only index we have at the time, began the bull market at about 25, and it went to over 1,000. So that's a 4,000% gain. And it had a 60% decline from 1968 to 1970, and one from 1974 to 1976. So we saw such a decline during the 2008 financial panic, and then we're seeing one now. So I know it's really difficult for people to watch this and to feel it and to own it, especially if you don't own these gold stocks at the bottom from 10 years ago or during the 2008 bottom. But this is actually pretty par for the course if you look at the history of these precious metal stocks. And again, this is how bull markets climb a wall of worry, because all the commentary you're seeing is negative and the global market's over, and this is why gold's not really a hedge, and all this stuff. And this is why you get these declines, to shake everybody out and to get everybody negative. And then what ends up happening is the market just bottoms and turns around. It happened in 1987 when stocks were in a secular bull market. It happened in 87 during the crash and in the 1990 recession and this sort of thing. So you have these shakeouts, and then usually the market continues higher. What I suspect is going to happen, a lot of volatility in the next couple of months, probably till the end of June or July, and then we'll start creeping up again in gold and precious metals prices. And one of the key aspects of all this, and this is the only indicator you really have to know, both precious metals, or all precious metals bull markets, ended the same way. And this is the late 40s or the early 80s, when the Federal Reserve began to raise interest rates and tighten monetary policy. And we see none of that right now. We're seeing actually Japan printing more money. We're seeing the Bank of England continuing its QE, the Federal Reserve continuing its QE, and the European Central Bank continuing its form of QE by buying Spanish and Italian debt to keep the rates lower in those countries. So if we were seeing tightening monetary policy, I might be extremely worried about the gold decline, but the fact that we're not, and if anything, the conspiracy theorists are talking about the central banks being behind this so they can continue their loose monetary policy. So if anything, now gold being, 25% and the stocks being 60% off their highs, now is reason for the central bank to continue the loose monetary policy. It's probably going to be very, very positive for precious metal prices going forward after this decline, like I said, in the short-term volatility.
Is that one of the things that's driving the price down? There seems to be a consensus around the media that European central banks specifically are about to get ready to sell their gold to pay down their huge debts.
Well, that's kind of your catch-22, right? Where maybe they wanted to do that, but now the price has fallen to the point where they don't want to do that anymore. Yeah. Cyprus is a very small player, and they'll probably sell most of their holdings to pay off, to help their bailout. But I don't really see Italy or Spain or France or any of these countries selling at these levels. After gold has gone from 1900 to 1400. So that's kind of your problem now, is even if they were going to, now gold took a big whack, and who knows how much they really want to anymore. And the one thing that still gets me about this whole debt crisis thing is how the United States still gets viewed in a different light. Mm-hmm. Like whenever you watch CNBC or Bloomberg or whatever, they just talk about how it's the European debt crisis. And there's a debt crisis in the United States. Just because rates haven't started to spike there yet doesn't mean that you're not within the problem of a very bad, secular government debt crisis. Japan has a debt crisis, and their interest rates are still below 1% on the 10-year bond. So there is definitely a problem in the States as well. And no one's talking about the U.S. dumping their gold. Mm-hmm. I really don't see it happening. And Cyprus is very much of a one-off, because it was, like Ireland or Iceland, a financial-based economy, when then their banks blew up. And Cyprus is also unique because there's a lot of Russian mafia money had transplanted deposits. So it was really, really a unique situation. I don't see that happening in the rest of the European Union.
David Skarica from AddictedToProfits.net is our guest here on This Week in Money. Let's talk about the other side of the coin, the markets. New York and Toronto, Dave, poised for a 2% weekly loss in the wake of those crappy earnings and concerns about growth. Here in Toronto, resource stocks beaten down. Canadian stocks, as you pointed out earlier, still down 22% from their peak almost 5 years ago.
The Canadian stocks have been hit by the fact that there's been this underperformance in the commodity equities. Even before this last decline, we saw the oil and gas stocks really lagging the price of oil and gas. We've seen the precious metal stocks. Remember, gold easily went through its 2008 high of $1,000 an ounce, went to almost double that at 1900 back in 2011. But the gold stocks went nowhere near double their 2008 highs. So we've really seen the equities lag the underlying commodity prices. since then, and Canadian markets being more commodity weighted, that's what's kind of dragged it lower. See, what we have to understand about the U.S. market is I think it's really dangerous right now, because even if we get another 5 or 10% upside, the problem is it's all driven by cheap money. And I mean not just the market, but the economy, the government, everything. That the only reason the government can sustain the $1 trillion deficits right now and the $16 trillion debt is because they can borrow at between 0.25% on the 6-month bond and 1.7% on the 10-year bond. If those interest rates doubled or tripled, which would just go to normalized historical basically levels, the government would essentially be insolvent. And same thing with housing. The only reason housing have its bubbles because there's just cheap money. Now, maybe not be like the 2005 bubble where everyone and their brother is borrowing and buying houses, but the higher end still has access to credit, and they can prop up prices with that. So we have everything predicated on cheap money, and then you look at earnings, like IBM and all the large, IBM just had terrible earnings, but even though IBM and all the large caps, they can all borrow at 1% rather than borrowing at 5 or 6%, and that 4 or 5% gap adds to the bottom line, adds to profit margins. So if rates go up in any significant form, it kind of bursts this kind of recovery bubble. And then on top of that, I think what's happened is perceptions become reality, where people are talking up. Remember that there's this old saying that bull markets climb a wall of worry. Well, it's kind of the opposite of bear markets. But bear markets, there's always this hope. And I think right now the hope has been during this cyclical bull market that, you've got this fracking boom in the States and these low interest rates and there's this big recovery, but we have labor participation rates at 30-year lows, and all the macro indicators tell you that there's not really a recovery going on, and a lot of this has been juiced by cheap money. And it's just a question of when that cheap money is going to end. I think it's going to end by 2015. So that's why, that's another reason why I think this precious metals decline and this stock market rally is giving you an excellent opportunity, if you haven't done so already, to exit the major U.S. equity markets and enter the precious metal markets or other beaten up markets. Like, probably a lot of subscribers will laugh at this. Well, there's no liquidity in this market right now, but I'm actually about to set up brokerage accounts in Cyprus and buy some of the stocks there because they're off 98% from their highs. So you don't want to be in these markets that are booming. You actually want to be in these markets that have collapsed, and that would be actually gold and precious metals and some other commodities and some of the European markets. And I would actually be using the rallies in the S&P. And I think the S&P is still going to take a while to top out here. I don't think it's just going to roll over right here. But I would use any rallies in the coming months to kind of slowly exit your U.S. equity positions and enter these positions that are really, really beaten up.
We are talking to David Skarica from AddictedToProfits.net. And Dave, I know it's kind of like catching a falling knife these days with gold prices and gold stocks. And it's awful tough to run against the herd. Any words of advice for us to kind of keep our heads on straight? No,
I just think you have to look at like where these things are. Like, again, one of the reasons that I've really liked Barrick recently is because of just the valuations of it. If you look at historically, even with lower gold prices, we know the earnings are going to come down. But even with these lower gold prices, you've got these stocks trading a lot of them single digits to low double-digit PDEs, which is unheard of for gold and precious metal stocks, and yielding like Barrick yields over 4%, Newmont yields 5%, Kinross yields 2 to 3%. Again, unheard of for gold stocks to yield that kind of money. So you just have to kind of go where equities are cheap. Anyone who was chasing Apple at $500 or $600 a share kind of learned that the hard way. So I think right now you just have to kind of look at these beaten up sectors. And on top of gold and precious metals, there's plenty of the commodity sectors. Like I said, a lot of markets in Europe, a lot of markets in cyclical industries like shipping that are really, really cheap right now that I would look at purchasing and kind of stay away from the S&P. And I think that's the real dangerous thing right now is that last summer when I was buying Europe, no one wanted to buy Europe.
Yeah.
And then had a huge rally. And now everyone wants to kind of do this trade where they're sick of precious metals or they're sick of emerging markets because they've lagged, and they all want to dive into the U.S. stock market because that's what's held up. And I think that's really dangerous right now. And you still have to buy cheap assets. And cheap assets can stay cheap for a while. They can stay cheap for a year, 2 years, 5 years. But if you buy these cheap assets, you're usually rewarded. And again, if you look at the gold and precious metals industry, it looks a lot like 2008. And for example, in the next 3 years after 2008, the HUI, the Amex Gold Bugs Index, quadrupled off its lows.
Wow.
So that's the kind of thing you have to look at right here.
David Skarica, author of The Great Supercycle, Profit from the Coming Inflation, Tidal Wave, and Dollar Devaluation. And you'll find him online at addictedtoprofits.net. Hey, Dave, I sure appreciate you taking the time to talk to us today.
Okay, thanks for talking to me.
Thanks to our guests, Mike Swanson, David Morgan, and David Skarica. And thank you for listening. I'm Phil Mackesy. Jim Goddard in next week with more This Week in Money.
This Week in Money is a production of Howe Street Media Incorporated.